Hi, everybody. This is Steve Maggi from SMA Law Firm. Welcome to Building the Bridge. And I have the honor of having with me today Mark Vanderlinden, a cross-border tax expert with over 20 years in the United States, working for the big four firms and now out on his own, helping a lot of my clients and maybe some of yours. Thanks for joining us, Mark.
You're welcome, Steve. Thanks for having me.
So I wanted to ask you a question about what are the most common areas that you see pop up for foreign nationals moving to the US when it comes to taxes?
Well, the most common area where I think foreigners coming into the US can save taxes or definitely should optimize their taxes is on the capital gain side. People have certain assets, most commonly is an investment portfolio whereby they have shares or mutual funds. And the capital gain on that has grown a while. They've invested for a while in those assets. So the question comes about, when do you trigger that gain? Do you do it before you move to the US? Do you do it after you move to the US? Well, the interesting part is that once you move to the US, first is the US doesn't give you a step up. They don't say, oh, you bought this share for $5. It's now worth $50 when you move to the US. So we're going to tax you anything over $50. No, they don't do that. They basically say you come in with a share that you once bought for $5. So immediately the US is going to tax that $45 difference. Another thing that you have to bear in mind is currency. And if you bought that share once, you bought it for €5, and the dollar exchange was 1-on-1, let's say, and now the dollar exchange is 1.3, you basically have a 30% currency exchange gain or loss on that asset. And if you sell that when you're in the US, you're going to trigger that. Imagine that you have a house that you buy for 400,000 euros and you sell for 400,000 euros. So locally, you don't see any gain. But because the dollar changed in the meantime 20%, you may report an $80,000 gain in the US.
That's
So
crazy.
kind of a phantom gain.
So you could have a house in Holland, let's say, you move to the US, then you sell the house, you get the 400,000 euro in your bank account in Holland, where you've made zero profit, but then the US government can claim that you're taxable on that difference in the exchange rate.
Correct, because the US monitors everything in dollars. So they say the moment that you bought the house in euros, we convert it into dollars. That was 15 years ago. Now you sell the house. Now we're going to convert again your euro sales to dollars. And guess what? There's a price difference there. So that's kind of a big surprise for people. But again, you can time this, because if you calculate what the dollar exchange was when you bought it or sell it, you may actually see that you find a currency exchange loss, and now you can use it in the US. So these are things you can do, especially if you're coming from the Netherlands, for instance. The Netherlands has a system that doesn't tax capital gains. They tax a deemed return every year, and your real return is irrelevant. So if you have shares that you own for a while and there's a huge gain on that, if you sell it before you move to the US from the Netherlands, it's not taxable in the Netherlands. If you sell it once you move to the US, it's fully taxed in the US. And because it's not taxed in the Netherlands, you don't get any credit for Dutch tax. So you're paying full-blown US tax on that.
Right, but logistically, it seems kind of counterintuitive, right? Because let's say you send me somebody, I help them get, let's say, an E2 visa so they can set up their business and they move here for 5 years. Obviously, they're not going to hold on to their property for 5 years if they need the money in the US, and they're not going to sell their property before they move, because then they'll be homeless. So what's the workaround here?
Well, sometimes you can do a transaction. If you're married, for instance, we could transfer your part of the house to the spouse, and that will be a fair market value transaction. And that's you bump up the value of the house before you come into the US. Those are things you can do. You could also consider maybe renting it out. If you know how much tax you're going to pay, maybe it's better to rent out the house for 3 or 4 or 5 years rather than selling it and triggering a gain. Or you can consider setting up a company. If the gain is really substantial, you could consider selling your house to a company you just set up, trigger the gain in the Netherlands tax-free, and then when the company sells the house, there's a very small sliver left because you just bought a house a month ago.
So the worst thing you can do, I guess your greatest enemy is improvisation, right? People
Yes.
being impulsive, or just seeing the money and the dollar signs and saying we're going to impulsively take this offer or take this decision, and then all of a sudden there's no recourse, right?
That, and I think on top of that, working, and this is the biggest mistake I see made, is working on the assumption that the system that you have, you're based in the Netherlands, the Dutch tax system, is the same as in the US. And you see by one country taxing gain and the other one doesn't, that basically you can make that assumption.
Right. Assumptions are also the enemy, right? Because
Oh, for sure.
people really do think, oh, everything's the same. They speak a different language, maybe. Maybe the political system is different, but most things should be the same, and taxes are taxes.
Yes. But it took me 25 years to get here and to fully understand the differences. And I'm trained in this field, right? So I'm looking for the differences. But I will always say there's no assumption without verification. If you assume something, verify that it's true.
And verify it through an expert, not on Google search.
Yeah, Google's not going to help you in this one.
What are some other tips that you have for people who are moving to the US in terms of minimizing their taxes or just protecting themselves from unnecessary taxes?
Well, the most interesting one that we do for our clients is people that own a business, and they own their business that's set up in a foreign limited liability company. Same thing with the question about the house moving to the US or your shares investment. You don't get a step up. You don't get a saying, oh, we look at the value of your business the moment you come into the US, and any value after that, we're going to tax. No, they don't do that. So we call it a step up in tax purposes. Now, interesting enough is even when the US Internal Revenue Code doesn't give a step up, you can create a step up before you move into the US. And we do this a lot for people that own a business, own shares in a business, to step it up. And this can actually save a lot of money, hundreds of thousands of dollars sometimes, that you can save by just doing some planning in advance.
Okay, fantastic. It's good for people to understand from our experience. They say that the difference between intelligence and wisdom is intelligence means that you learn from your mistakes, but wisdom is you learn from other people's mistakes and you don't make them. And so that's why experts are in place, right? Experts like you, because you've seen every possible different kind of variation, I would imagine, in situations, and you've seen horror stories happen because people didn't plan. So my question to you is, how soon is too soon to pre-plan before you come to the US?
That depends. I mean, the thing is, there's no singular treatment for every little item. Every little item of income, if you look at the treaty, is treated differently. A dividend is treated different from a capital gain. A pension is treated different from a salary payment. So actually, you have to take an X-ray, pull it apart a little bit, and see what are the moving parts, and then per moving part, put a timing on there. And that's generally the approach that I to take a snapshot and look at, well, if we do slightly things differently, you're going to end up in this situation rather than that situation.
Gotcha. So if somebody wants to work with you, they want to try to minimize their taxes, they want to plan, and really they now appreciate after watching this video how much detail is needed to really assess a case correctly to come out with a three-dimensional strategy. How do they get in touch with you?
Well, we're going to post my email and my phone number here, my cell number available. People can reach out to me directly and we'll take it from there. I generally do a Zoom introduction call with my clients whereby we connect directly their background, their facts to my knowledge base and my understanding. And then people can quickly figure out within probably an hour what are the relevant issues that you can do. And my approach is generally, listen, for 70%, the law and tax is nothing more than a law, does what it's supposed to. In 30%, it doesn't do what it's supposed to do. And in that 30%, half of it, 15%, you're lucky, 15%, you're in trouble. So the game plan is for 70%, we know what the outcome is. That's an easy question. For 15%, we're going to bring you to where you need to be and where you're going to be lucky.
Eliminate the luck part and that's where the planning and the strategy comes.
Exactly, yeah.
Thank you so much for joining us, Mark. Really appreciate your time and your knowledge.
No, great. Thanks for having me.